welcome back everyone to Fear-Free Passive Investing. We have an awesome show today. Today we are interviewing Brian Burke. Now, some of you might have heard of Brian, but if you haven't, he's the president and CEO of Praxis Capital. Brian's been purchasing properties for well over 30 years and has acquired 750 properties, including over 2,500 multifamily units. Praxis's current portfolio exceeds $200 million of assets under management, which is awesome, staggering. He's a recognized real estate expert in this field. If you haven't heard of him, he speaks all over the place. So he's really, we're fortunate to have him on the show today. But first, before we jump into that show, I want to give a quick passive investing tip. If you hadn't noticed, Bandit Capital has an awesome YouTube channel where I've been posting education material for passive investors. So if you haven't checked that out yet, click the link in the description of this show and it'll take you right there. Be sure to subscribe and turn on notifications so you can check out any new videos that I post. So now that we have that out of the way, let's talk with Brian. All right, Brian, thanks for being here. I really appreciate it. Thanks, and welcome to the show.
Thanks for having me on.
So, I'm sure there's a lot of people who have heard about you and maybe even heard other interviews with you. But for those who haven't, maybe in 30 seconds, can you take us through your real estate investing journey? Where you've been, how you got started, and where you're at now.
Geez, the quick version is I started like a lot of people. I was flipping houses. I did my first house flip when I was like 20 years old. And this little cheap house, never knew what was going to come of it all. And it's now been 30 years. And unbelievably, we just crossed the $500 million mark in real estate purchased. So it's been quite a career. So I went from single family flips to single family holds to multifamily and, done everything in between, some development and gosh, you name it.
Yeah. I would imagine over that last 30 years, you probably had a lot of experience with passive investors or at least folks that are investing capital into your deals, let's say.
Yeah, I would say so. We've somehow been lucky enough to have raised over $100 million from investors, kind of the hard way, $100,000 checks at a time.
Yeah. So, over those conversations, I'm sure there's been hundreds of them, if not up into the thousands. What would you say is like the number one fear that new investors have when learning about this? Let's stick with commercial syndications.
Well, most people, it's a bit of a black box. They don't understand how it all works, and understandably so. It's a complex landscape, and people don't know what to look for, what questions to ask, what are red flags and what aren't red flags. There's a lot of misperceptions out there where some people think that if the sponsor has invested money in the deal, then that means that their interests are aligned and they can go ahead and invest with them, when really nothing could be further from the truth. I mean, just because they invested money in the deal doesn't check the box that the sponsors met all the requirements they need. I mean, there's a lot of other things to look for. So there's some misconceptions out there, and people are kind of asking some of the wrong questions. And it just seems like if they don't know what to ask, then they just don't make the investment or don't even look at them.
Yeah, you touched on something that I was going to bring up in a few minutes, but let's talk about it now. What are some of those wrong questions that they're asking?
Well, a lot of times investors are focusing on the returns. What are the returns? What's the IRR? What's the cash on cash? What's the equity multiple? And while all those are really good questions and they're important, it's important to know whether the investment meets your objectives. The real question is, how did the sponsor arrive at those projections? And, I can tell you all day long, I'll get you a 20% IRR in something, but if the projections are all screwed up, we'll never deliver it. So the right questions to be asking are things about, what rent growth are you forecasting and how did you arrive at that forecast? What economic vacancy are you forecasting and how did you arrive at that forecast? What third-party data can you provide that will support your thesis Do you have comparable rentals and comparable sales to support the acquisition and support where you're planning to take rents? And do those comparable rentals really make sense? Are they true comps? All of those things, really what you're doing is you're diving into whether or not the sponsor's calculations are reasonable and likely to be achieved. Because if they are not, then whatever returns the sponsor's projecting is just numbers on a page.
Yeah. That's so important to have quality data that supports your assumptions, and you're not just working backwards from, hey, I want a 15% IRR on this deal. How can we make that work? And just trying to work backwards. I've seen that a few times, but I've talked to a few passive investors, and they have been asking a few questions, and they've always been apologetic. I'm really sorry for asking this so much. I'm sorry for digging in. And for me personally, it's a fine line. I as a sponsor, have a fiduciary responsibility to investors that are already invested in the deal to not spend a lot of time, going down these rabbit holes of people who are never going to invest. But then I want to provide such a good service and good detail so that I make the case for this investment. Where do you fall on that? How much time do you spend on that? And, where do you draw the line?
Well, we never draw a line at asking questions. No question is off limits. Everything is fair game. If somebody's going to trust us with 6 figures of their hard-earned cash, they darn well better do it knowing full well exactly what they're getting themselves into. So I want them to understand everything clearly and completely before they make their investment. So to me, it's an open book. Although, having said that, I'd really like for the investor to ask no question at all. And I don't mean that because I don't want to answer questions, and I don't mean that because I don't want the investor to ask questions. I mean that because I want to be able to put out collateral material that explains this investment to the investor so clearly and concisely and precisely that the investor has no questions left to ask. If I've really done my job as a sponsor, then I've anticipated every question an investor is going to ask me, and I've answered that question in my collateral material so that when they read that, they know exactly what it is. And we'll never get perfect at that. There's always going to be something we forget to include, or somebody has some random off the wall question that I'd never heard before, but it's a good one. I've seen that happen a lot, and it's great to fill in the blanks with whatever we missed, but we should really be anticipating and answering all the questions ahead of time.
Yeah. And I think sponsors know that. They know the questions that are going to come up. They know the weaknesses of the deal. And if they're trying to hide it, it's going to come up eventually, right?
Well, I would say that anybody that's been doing this long enough is probably can anticipate the questions. If it's your first deal, or you haven't been doing this for very long, you probably have no idea what questions investors are going to ask. Because what's interesting that I found over the years is every investor is different. Each one of them has a different hot button or particular thing that they really want to focus on, or a question they really need answered. And there's so many. So if you have 500 investors that look at the deal, there's 500 potential off the wall questions. And there's always something you didn't think of. But generally, if you've been doing this long enough, you've heard most of them before. So you might as well put it in your offering material so that you don't have to answer the question after the fact 50 separate times.
Good point. Yeah, that's good advice for people who want to get to where you're at too. Let's talk about the fear of like another housing crash. That's one of the biggest fears I have, or that I hear from investors, is saying, what happens if next year is the next 2008 or worse, for multifamily housing? How would you respond to an investor asking that?
Well, first of all, just because the 2008 crash looked the way it did doesn't mean that all crashes look like that. In the 30 years I've been in this business, I've managed to survive 5 or 6 market cycles, however many there's been. Some of them have been little mini cycles that only lasted a short period, but every different economic dislocation looks different. And I remember back in 2000, there was the dot-com crash and the subsequent economic fallout after that. And I was in real estate and building houses and renting houses and selling houses. And, all of our rentals were full. All of our houses were selling. And I didn't even notice it from a real estate perspective. Contrast that to 2008. If you didn't notice 2008, you were obviously either asleep or dead, because everybody that was in real estate felt it, and it was really super painful. So, now we're at this stage where that downturn was 11 years ago, or 10 and a half or whatever years ago. And, if somebody's only been watching, markets for a decade, or if they're only 40 years old, then it's likely that the only economic dislocation they've ever experienced is the one from 2008. So there's a default thinking that they're all going to look that way, and that the next one's right around the corner. And, I'm just going to wait until I can go pick up real estate at 50 cents on the dollar, and that's going to happen in 2 years, and this and that. I just don't buy it. The fundamentals supporting the real estate market right now, if there is such a thing as the real estate market, but in general, the fundamentals supporting real estate are very favorable, and there's a lot of runway left, and I think it's going to remain that way. Now, I also feel that anything that you buy today needs to be underwritten with the preparation for an adverse economic cycle. And as long as you're planning for it, and you've underwritten for it, and you're financing appropriately, then you'll be around to live to see another day. If you're looking to invest in a passive offering that's got 90% cost, bridge debt that's expiring in 3 years, and you're extremely over leveraged and has a 1-to-1 debt service coverage ratio, I would be nervous too. But if you're investing in things that are conservatively financed with reasonable loan to value ratios, reasonable default ratios, reasonable debt service coverage ratios, even in a dislocation, you should be able to survive and sell at the next market cycle peak. And you should be prepared to do that if that's what it takes.
Yeah, you touched on a lot of good things. Real quick, I want to ask you just a question that just came up. What's your preferred financing right now? What's your preferred product?
My go-to is the Freddie or Fannie agency debt, 65 to 75% floater. The reason I like the floater is because I can sell or refinance anytime I want after the first 12 months. Part of our strategy here is, we acquire, we improve, we increase income, we improve operations, and then we sell. The worst thing I can imagine is that I accomplish that and I do a fantastic job and I'm able to sell and create a huge profit in 3 years. And now I got to pay $1 million yield maintenance penalty to exit my fixed rate long-term loan. So I'm not a fan of the fixed rate product right now. If you look at interest rate forecasts on a go forward basis, rates aren't really expected to move a whole heck of a lot, especially to the upside. So, I feel very comfortable in a floating rate product that allows me complete flexibility to do what the market is telling me we should do, not what some yield maintenance penalty is guiding me towards.
Yeah, that's a good point. That's something that investors really need to think about too, is because that will dramatically change how long deals are held, what the sale proceeds are going to look like, and all kinds of stuff. So that's really important to talk about. I want to talk about underwriting because you mentioned it before, and I know this is your specialty. How do you underwrite for a potential economic incident or slowdown or whatever you want to call it? How are you doing that?
Yeah, great question. It's enormously important right now to be aware of the climate that you're investing in and underwriting to that reality. So here, I'll give you a couple of examples of the way I've seen some underwriting going around out there lately. Let's say you're in a really hot market and cap rates are really low. They're 4.5%. And vacancy rates are 5% or 4%, and the property's performing at 98% occupancy. And so it's tempting for people, and 6% rent growth for the last 2 years. So it's tempting for people to underwrite the future with 6% rent growth, 3 to 5% vacancy, and an exit cap rate of 4.5%. And I call that underwriting to perfection. And what that means is that everything has to happen perfectly in your favor in order for you to meet any of the projections that you've made. You can't have any fall off in vacancy. You can't have real estate become any less desirable, uh, and um, and you can't have any additional vacancy factors or any less rent growth. So that just doesn't it doesn't happen that way, and it's not I don't expect it to continue to happen. So what we do is we look at what we think rent growth is going to do, not what rent growth did. So if rent growth was 6%, but the forecast by all the economists that really have the PhDs and dive deep are saying that rents are going to grow at 3%, despite the fact they've been going at 6% for 3 years straight, we're going with 3% or maybe even 2.5%. If the vacancy has been 3% at the property, but the submarket overall is at 5%, but the long-term average over the last 20 years is 7%, I'm going to be underwriting to 6 or 7% vacancy, despite the fact that it's 2-3% right now. If cap rates are at 4.5%, which means that real estate is super desirable, I'm going to assume that real estate's never going to get more desirable than it is right now. And that later on when I go to sell, real estate might be less desirable as an asset class than it is today, which means that cap rates would rise, meaning that I can't underwrite to that 4.5% exit cap. I need to be underwriting to a higher exit cap rate than what cap rates are set to now. So that's just some of the things. There's a lot of different economic vacancy factors that we look at and have to underwrite conservatively towards, and post renovation rent rates and all that sort of stuff. But those ones I mentioned, those first three are kind of the big ones that I see most often as being a mistake.
Yeah, I think probably the cap rate reversion one is one of the most popular ways to say, oh, I've done a sensitivity analysis, where all they do is essentially do what everybody teaches, right? 0.1% for every year held, right? So you can clearly see, oh, if I'm buying at a 6 cap, if I sell at a 6.5 cap, I'm good, right? The deal's safe. I'm conservatively underwriting. You're not saying that, right? You're saying you go way deeper than that. You look at a lot more stuff, and you do a lot more data driven stuff, right?
Well, we do a lot of data driven stuff, but I can't fault anybody for the tenth of a percent per year. But where people tend to go wrong is that you're buying a value add property at, let's say, a 4.5 cap. I'm just going to use an example. And then you go through, your plan is to renovate it, increase rents, and resell it. Well, the reason you paid a 4.5 cap is there was meat on the bone that you intended to harvest, and you were going to bring that income up and resell later on. So that upside made that property more desirable for you. Once you've renovated the property and there's no meat on the bone left and you go to sell, your buyer really is looking at this really as a coupon clipper. It's a cash flow play. There's really no upside or meat on the bone. So that makes the property less desirable. Less desirable means higher cap rates. So a cap rate for a stabilized non-value add deal is higher than a cap rate for an unstabilized or value add deal. So you can't buy a value add property at 0.1% per year and call it good. I mean, first thing you have to do is you have to take away the value add premium and then do a time adjustment. So if we buy a value add at a 4.5, I might see stabilized trading at 4.75 and then do my half a point or my 0.1% per year on top of that. And maybe your exit from a 4.5 is a 5.25 or a 5.5 in 3 to 5 years versus, just going at, 4.7 or 4.8.
Yeah, the point you made that I was trying to get at is you're doing it from a prevailing cap rate, not from your going in cap rate, which I think is where some people go wrong that I've seen anyway. But that just gets back to
Yep.
trusting your sponsor, right? That's so critical. How can a passive investor know who they're talking with is trustworthy? And well, yeah, let's just go with that.
Well, one of the things that speaks the most highly towards this is the length of time they've been in business. If someone's not trustworthy, they're going to be in and out of this business pretty quickly. the trouble is that makes it tough for guys that are just starting out. If you're, on your fourth or fifth deal, or you're in your third or fourth year, it's really difficult. But, that's just part of the way it is. I mean, I've been doing this for 30 years and our business didn't really start growing until after I'd been doing it for 20. So, you can't expect that you're going to start in this business and all of a sudden just take off. So that length of time that you've been doing this, to me, speaks volumes, because you aren't going to last if you aren't doing it right. So that's probably the biggest one. The second, of course, would be track record, looking at acquisitions and exits and how they performed. One of the things that makes that tough right now is in the last 10 or 12, or, well, let's see, at least the last 7 years, we've only seen an up market. And, an up market doesn't say much about the investor's ability to, produce or perform. It just says they might have gotten lucky from, favorable market conditions and tailwinds. So, be careful. Track record is important, but you have to look at the context of that track record, and, couple that with the sponsor's background and experience, the team that they have behind them, and, how many units and years and all that other kind of stuff.
Yeah, that's a great answer to that question. I think a lot of people who are just getting started, myself included, I'm right in that window you were talking about. I think year 5 is where I'm at. It's hard to convey that. I know a little bit about what I'm talking about, but the way I get around that is I partner with people who are much more experienced than me, right? I draw on years and decades of experience. That helps bring a lot of trustworthiness to this, and get folks on the team like yourself that have seen the down times and they know the questions to ask. And I think that's so critical. So for me, if I was a passive investor, and I am a passive investor, but if I wasn't actively investing, I would ask that, who's on the team that's been there and done it before, basically.
Yeah, I think that's a great point. And it's difficult to, speaking to the syndication sponsors that might be listening, that are newer and trying to figure out, gosh, how do I really, make it in this business? It's, everybody wants to go from zero to hero instantly. But, everybody has to remember that no one was born as a full grown adult and, came right out of the womb and went and wrote the hospital. Everybody goes through a growth stage. You're born and you don't even know how to eat or walk or talk. And then one by one, you learn how to do all those things. And eventually, over a number of years, you become a full functioning adult. And, in this business kind of works the same way, where, you got to crawl before you walk and walk before you run. And it takes a long time to establish yourself in this business, and for a good reason. People are parting with hard-earned cash, and syndication sponsors sometimes forget how difficult it is to save up $100,000 to invest in a syndication with someone that you've never met. That is very valuable cash, and you're not going to part with it easily. And so it's very important that you have a lot of trust in the person you're investing with, which is why most newer sponsors start out in the friends and family circle, and, people who already trust them for other reasons, and they grow their business from there. So, these businesses grow organically, and that's probably not a bad thing.
Yeah, and that's really important to think about too. Is um, how many hours did they trade for that $100,000 investment, or how many late nights did they put in? Things like that that really personifies the money in my mind. That's something I always think about. So I want to give you a chance to put on your thinking hat and your wizard hat and look into your crystal ball. Where do you see things going in the multifamily sector for the next, let's call it 5 years? What do you see macroeconomically and all the way down into micro, and maybe some of the areas that you're looking to buy properties?
Well, from an overall big picture, I think multifamily real estate as an asset class is a good place to invest, because it's a housing investment which is always in demand. Uh, Over the past probably 2 or 3 decades, on a macro level, incomes have been increasing and household size has been decreasing. A decreasing household size means that people are going to tend to live in smaller accommodations. So that means they might live in apartments versus houses, or in larger apartments versus smaller houses, and that sort of thing. So with that demand continuing to be a demand side pressure on multifamily, and supply constraints always being an issue, whether it's construction cost, regulatory climate, availability of construction labor, whatever a reason it is, it doesn't seem that housing construction keeps up with housing demand. So on an overall basis, it looks to me like there's a lot of runway left. The increasing income side allows people to continuously pay more, right? So you can afford rent increases, you can afford better accommodations as your income increases. So I'm watching incomes rise and households shrink, and that to me leads very well into multifamily. From a micro level, this is about 15,000 different discussions, because from a micro standpoint, every submarket is different, every street can be different, every property can be different. It's important to identify assets that have some type of upside play, something that you can physically do to improve the income or the asset, to help you achieve your business plan. And that can be done in any economy, in any climate. Even in the middle of a downturn, you can make money in real estate if you play it right.
Yeah, that's a good point. The submarket or microeconomic areas that I was talking about are, I just want to drive home the point that just because you buy, a rundown multifamily building doesn't mean you're going to make money on it. Things that play into what you're talking about,
Mm-hmm.
underwriting, solid fundamentals, good financing, all those things play into it. And you're certainly not saying that just because you buy a crappy building means you're going to make money on it.
Absolutely true. I've made money on junk properties, and I've lost money on really nice properties. So, and the other way around as well. So it's always about the asset, the submarket, and the execution. And the execution is a amalgamation of both acquiring the property and operating and properly selling, disposing of it. So everything has to happen right in order to have success. And I'll tell you, it's a hell of a lot harder to make $1 million than it is to lose $1 million. That's easy. So it takes a lot of effort and a lot of really good decisions in order to have a successful outcome.
Yeah. Well, Brian, I want to be respectful of your time. I really appreciate it. I've got one question left. What advice would you give to someone who's interested in passive investing in real estate, but they're fearful to take that first leap and jump right in?
Well, I would say hold on to that fear, because there's good reasons to be fearful, because that means you're being cautious. You never want to jump in just because you heard some great pitch or saw some huge number on a page telling you what return you were going to make. If you thoughtfully examine the sponsor that you're looking to invest with and the offering that they're putting in front of you, and systematically break it down to determine whether or not the assumptions that they're projecting are make any sense, and whether the sponsor's experience and track record seem appropriate and make you comfortable, then it's time to go ahead and take the leap. If you aren't comfortable, or if your gut tells you not to do it, don't do it. If every time you ignore that feeling, or you ignore the obvious warning signs, or you just assume that, just because the materials were crappy doesn't mean the guy doesn't know what he's doing, so I'm going to give it a shot, that's when you start finding yourself in trouble.
Yeah, that's important to note. Fear is not something that is just made up in our heads, right? Fear is an evolutionary construct that we have come up with to give us that extra edge, whether it's hunting for food or whatever. Fear is important. So don't ignore that. And I really love that advice. So if people have questions or they want to find out a little bit more about you, where can they reach you or look you up?
The best place is on our website, which is praxcap.com. It's praxcap.com. Or, of course, I'm active on the biggerpockets.com forums. I can be found there frequently. Either one of those places is probably a good place to look.
All right. Thanks, Brian. I really appreciate your time.
Thanks for having me on. I appreciate it.